Today, I want to talk about what I think is one of the most underutilized accounts when planning for retirement. In fact, if used properly, it can be almost as powerful as a Roth IRA from a tax perspective, and it also allows you a lot more flexibility. I did a similar video about a year ago, but I received feedback that not everyone understood how these accounts worked or how the taxes work. So to help illustrate the power of this account, I'm going to walk through several real-life scenarios to show you how you could use this account to reduce your taxes in retirement. But first, my name is Kevin Lum, and this channel is dedicated to helping 1 million people retire without worry. Now, before I dive into the strategy, I need to take a minute and just explain how taxes work. If you are a tax expert, you're thinking, but he's glossing over 1 million things. I know this is not meant to be a comprehensive overview of taxes, but I think it'll help you understand the concepts later in this video. One quick note, everything I'm talking about today is referring to your federal tax rates, not your state tax rate. This would be a very long and very complicated video if I tried to explain each different state's tax rules. Everything we're talking about today is just referring to the federal tax code. When you file your taxes, you get to subtract a chunk of income right off the top. So as long as you earn under this amount, you pay $0 in taxes. It's called a standard deduction. And you can choose either the standard deduction or the itemized deduction. But almost everyone today chooses the standard deduction. If you are married filing jointly, you get to take $29,200 off the top. And if you're over the age of 65 and you're married filing jointly, you get to add an additional $1,550 for each qualifying spouse, meaning that if you're married filing jointly and you're over the age of 65, you can take $32,000, actually $32,200 in tax deductions. Single filers get to deduct $14,600 plus an additional $1,950 if you're over the age of 65. So that's the first thing you need to know. The second thing you need to know is there are basically two different tax structures. There's ordinary income, and depending on how much you earn, you're going to be in a different tax bracket. The 10% tax bracket, the 12%, the 22%, the 24%, all the way up to the 37% tax bracket. Now, most of the income you receive is going to be taxed as ordinary income. So the money you make at your job, distributions from your 401k, pension payments, interest from high yield savings account, ordinary dividends, all that money is going to be taxed as ordinary income. The more money you earn, the higher your marginal tax rate is, the higher amount you're going to pay on each additional dollar that you earn. So ordinary income is taxed at one rate. By the way, I will put a cheat sheet in the comments that you can download with all these numbers for 2024, so you don't have to jot them down. The other structure is capital gains tax, and it's typically taxed at a much lower rate than your ordinary income. Now, if it's short-term capital gains, you're going to be taxed at your ordinary income tax rate. But in long-term capital gains, so these are assets that you've held for more than a year, you are going to receive a preferential long-term capital gains tax rates. For most people, the items that will be considered long-term capital gains would be the sale of a stock or a bond, crypto, maybe a house, maybe a business, anything that's considered an asset. So when you sell those assets, as long as you held them for a year, you will qualify for a preferential tax rate. And that tax rate for many people will be 0%, meaning you pay no tax on those gains. Now, it's important to understand that your capital gains rate can be impacted by your ordinary income, and your ordinary income rate can be impacted by your capital gains, which is why I think it'll be easier to just show you. So before I share my screen, let me just set up the scenario. We're once again going to visit Phil and Claire, and they're 65 years of age, and they need $120,000 a year to live. They need about $10,000 a month. Now, I know some of you are saying that's way more than the average person needs. I really like easy round numbers, and so I tend to go with numbers that are easy. $10,000 a month is easy for me to do calculations on in my head when I'm talking. So they need $120,000 a month, and they have about $500,000 in their IRA, and they have about $500,000 in a taxable brokerage with a cost basis of $250,000. Meaning they have $250,000 in long-term capital gains in that taxable brokerage, right? So the cost basis is the price they paid for the stock, and then the additional value is their long-term capital gains. So they paid $250,000 for the stock. It's worth $500,000 today. So they have $250,000 in long-term gains. In addition, Phil has a Social Security benefit of about $3,000 a month, and Claire has a benefit of $2,000 a month for a total of $60,000 a year in Social Security benefits. Okay, now let's switch over to my screen. So here we have some software that I use called Holistiplan when I'm doing tax planning. And remember, they need about $120,000 a year in order to live. So we've got a couple of different scenarios. In the one scenario, Phil and Claire have their Social Security benefit, plus they have taken long-term capital gains out from their account. So if they have a $250,000 gain, if they need $60,000 in addition to their Social Security, $30,000 of that income is going to be long-term capital gains. $30,000 of that income is going to come from the cost basis. Now, it's not always quite that clean, but for this illustration, we're going to pretend that it is. The second scenario is if they pull their money from an IRA plus their Social Security. So they'll take $60,000 from their IRA, plus they'll have $60,000 in Social Security income. The third scenario, they're going to pull $125,000 in long-term capital gains. So they're going to take out half of that taxable account in 1 year. And I want to show you what the tax in that would be. So here we have the tax year is 2024. It's the current tax law. As you know, at the end of 2025, the current tax law is going to sunset. We don't know what will replace it or what comes after that. So that is one thing to think about as you're planning. So here we're going to just quickly look. In the one scenario, they have $60,000 in Social Security income, and the amount of that income that is taxed is going to be $19,600. If they take out capital gains, if they take out a distribution from their IRA, $45,000 of their Social Security benefit will be subject to tax. Here you see they take $30,000 in long-term capital gains. Here they take zero. We'll deal with the third scenario in a minute. And their total income in the first scenario is going to be $49,600. Their total income in the second scenario is going to be $105,000. Now, this is the income for tax purposes. In both scenarios, they'll have about $120,000 to live on, either from an IRA distribution or from money that they take from their taxable brokerage account. So then you can see they have the standard deduction, $32,000, because they are both age 65. And so the total taxable income after you subtract the standard deduction is going to be $17,300 in scenario one, and it's going to be $72,800 in scenario two. And so the total tax that they will pay in scenario one is going to be $0. And then the total tax they're going to pay in scenario two is going to be about $8,200. So even though they have the same amount of income, if they're able to take the money from their taxable account, even though they have gains, they'll pay $0 in income. So let's actually click into this and look at it a bit more. Let's look at a tax report. So here we have a tax report for Phil and Claire to kind of help make this a little more tangible. So as you can see, they have $49,000 in income for tax purposes. Now remember, they need $120,000 a year to live. $60,000 is going to come from their brokerage account, $30,000 of which is long-term capital gains, plus $60,000 in Social Security. So let's look at these numbers a bit more. So let's go to the right side. So you can see they've got no ordinary dividends or qualified dividends, but they do have $30,000 in long-term capital gains, and then $60,000 in Social Security income, of which $19,600 is subject to tax. I have another whole video where I talk about how Social Security benefits are taxed, so I won't go into this, and they're still in the 10% marginal tax rate. How this works is they've got $49,600 in AGI, or adjusted gross income, but then they get a deduction of $32,300, leaving $17,300 in income. But if we come down here and look, they have no ordinary income, even though Social Security is taxed as ordinary income, at least the portion of Social Security that is subject to tax. But because of the standard deduction, they don't owe any tax on their ordinary income. So we can come down and look now at the marginal tax bracket for long-term capital gains and qualified dividends. And you can see here that $17,300 in income. But as you notice, the marginal tax rate on the first $94,000 in long-term capital gains is 0%. So they owe no tax. In fact, they could use some of that extra space to do tax gain harvesting, which is where they reset their cost basis by selling some of those shares, taking the profit, resetting the cost basis, so that later on when they need that cash, maybe for Roth conversions or to live on, or maybe they have RMDs coming out and they don't want to take this money out, they could take out more money than they need and use up some of the free space that they're leaving on the table in this particular scenario. And so now we come down here and see that their modified adjusted gross income is $49,600. so they won't have any Medicare surcharges. So their premium will be $174 for Medicare Part B, and Medicare Part D is included in the plan. Now I want to look at the final scenario. So as you remember, in scenario 1, they take out some money from their taxable brokerage plus Social Security. In scenario 2, they take out money from their IRA plus Social Security. In scenario 3, they have no Social Security income coming in. I just want to see how much money in long-term capital gains they could take out completely tax-free. So now let's go back over and let's look. I just want to show you this scenario really quick because I think it's interesting. So here we come. Let's look at the tax report. So in this scenario, we're going to pretend that Phil and Claire have no other income, no Social Security. They haven't started Social Security yet. They have no RMDs, no IRA distributions. All they have is some profits in their brokerage account. And so in this scenario, they're going to pull out $250,000 out of their taxable brokerage. $125,000 of the money they're pulling out is going to be subject to long-term capital gains. So you can see here the total income is $125,000. The deduction is $32,300. The total amount of income that's going to be subject to tax is $92,700. And I'll come over here and see the long-term capital gains at $125,000. Once again, there's no ordinary income. So we can see here they have taxable income of $92,700, and they could have earned up to $94,000 and paid zero tax. There's even a little bit of extra room there that they could have deducted. So they pulled out $125,000 completely tax-free. And I think that's one of the things people miss with a taxable brokerage account when planning for retirement. The money is way more flexible. You can take a securities-backed loan out against the account. You don't have to wait till you're 59 and a half to tap into it. There's just a lot of flexibility with money in your taxable brokerage account, but you can also pull large chunks of money out of that account tax-free, particularly if you retire early and delay Social Security. It can be a very tax-efficient account. You see here still the modified adjusted gross income is $125,000, so they're not subject to any additional Medicare premiums or the IRMA surcharge. I hope those examples were helpful, but there's even more. Dividend income gets taxed in two separate ways. Some dividends are taxed at ordinary income tax rates, and it's called ordinary dividends. Real estate investment trust, a lot of ETFs, there's these income producing ETFs that'll sell options on the NASDAQ or whatever. All those get taxed as ordinary income. Same goes for the interest that you're getting from a CD or from your high yield savings account. But there is another type of dividend called a qualified dividend. So if you have stock in AT&T, let's say, and you get dividend income from that AT&T stock, that's considered a qualified dividend, and qualified dividends are taxed at your long-term capital gains rate. So if you have no other income coming in, you could earn almost $120,000 a year without paying tax on any of those dividends. So let me show you the difference in the taxation on qualified dividends and ordinary dividends, because I think this is something a lot of people miss, particularly people using a lot of these ETFs to generate income. They're doing it in a very tax inefficient manner. So here we're back in our tax software. We're looking at two scenarios. Person has qualified dividends and person has ordinary dividends. Both have $100,000 a year in total dividend income. And so we can look down here. And again, everything I'm talking about is just federal income tax, not talking about state income tax. So you have $100,000. We still have the $32,300 standard deduction because it's still set to someone who's age 65. The taxable income for both is $67,600, but remember one gets taxed as ordinary income, one gets taxed as long-term capital gains. And you can see that the total tax that person A will pay is $0. The total tax the second person will pay is $8,000. So even though they both have the same amount of dividend income, the one person's going to pay significantly more. Does all that make sense? Let me know in the comments if you understood or if there's anything that wasn't quite clear. But hopefully you're beginning to understand the power of using the tax brackets to your advantage and also using a taxable brokerage account to your advantage. And these strategies work particularly well for people who have no other income coming in, so they don't have any pension income or annuity income, and also for people who are going to delay their Social Security benefit as long as possible because you have a larger window to be able to take out money in a very tax efficient manner. Now, if you enjoy this content, if you do me a favor, ding the bell, click the subscribe button, click the like button. All those things help the algorithms know that this is content worth watching. And finally, if you want to know more about how your Social Security benefits are taxed, I have a whole video where I walk through that, and you can watch that now.